Okay, so we're going to go ahead and pick up with chapter 12, and we're going to look at the chapter 12 slides here dealing with investments. And so let's just see what we have here. And again, these slides, guys, as you know, are up on B courses. Okay, and I will typically use the the slides that the publisher provides. Okay, but going to be a little bit cumbersome because I don't have my little mouse, my little clicker with me, but we'll work through that. Okay, so these are the slides. This is chapter 12, and we're going to be talking about investments. So as I said in the introduction, what we're going to be doing is rounding out our discussion of assets, frankly, at this point. Okay, we almost got it done in Intermediate 1. We'll finish it today. The discussion of, we'll probably go a little bit in Chapter 12 next time, but we'll finish investments in Chapter 12, and then we're going to turn our attention to the liability side of things. Okay, so when we're accounting for investments, the presumption is that an entity has purchased either equity, which is stock, or has purchased what? Bonds, which is debt investments, either debt or equity investments. Okay. Now, once those have been purchased, of course, as accountants, we will be doing the accounting. So we're not necessarily the ones making the decisions as to which bonds, which equities the company will buy, but we certainly will be in position to do the accounting for those transactions. Okay. So you come over, and when we talk about financial instruments that the entity has invested in, okay, and I'm not going to be happy with this. I'm going to be tied down if I don't. I have to have my clicker, it turns out. This is the one that has the batteries in it. I don't suppose any of you carry a switchblade, do you? No? Okay. Just thought I'd ask because I've got this tape on here. Once I can get the batteries out of here, I can go from there with the other one. There they go. Okay. That'll go there. Take this. And I can put this here. Okay. All right, good. Much better. Okay. So when we're looking at the types of investments that will be being made, as I said, we will have equity investments, which are typically stock, both common and preferred. You remember that what? Preferred stock is going to receive dividends before any common stock would. What's the benefit of common over preferred, though? Because obviously preferred is preferred, and you're going to get your dividends first. What feature does common stock have that preferred does not? Voting rights. Good, right? We have voting rights with common, but if we wanted to get our dividends a little quicker, then we would go ahead and get our preferred stock. When we're talking about debt securities, we'll talk about bonds, investments. We'll say a little bit about notes, but mostly we're going to focus on dividends. Now, we say that there's two objectives, okay? One is to receive dividends or interest. Dividend is going to go with what? The stock. Interest is typically going to come from the bonds, the notes. Now, we could also decide to invest because we want increases in market price, right? So, I don't know. Maybe if you had bought Apple, 20 years ago or something, you wouldn't be here right now, right? As that's increased in value over the years, right? Okay. Now, which one would you prefer?
dividend interest or growth stock?
Which one would you invest in? Huh? I mean, if it's me, I'm right here, guys, because I'm to that stage in life, okay, where I'm now looking to what? To draw income, okay? I'm writing the word income there, okay? You guys might be more over here. We would call this kind of stock what? A growth stock, and maybe you're going to be more interested in investing here if you're looking for that stock to increase in value because you have a longer time horizon than I do, right? So it really depends on the objective of the entity. Are we looking more for growth? Are we looking more for dividends, which will determine which company stocks we buy? Okay, and again, this is not an investment class. We're just worried about the accounting. Okay, now we're going to start out talking about debt security. So we're going to start out talking about the bonds. Okay, and so we have the date as to when the bond matures, face amount that is paid to investor on maturity, and in the meantime, before we pay off that maturity, before it's paid off to us, we're the investor, we of course will be getting interest on those bonds, on those debt securities. Okay, so let's just take a look at this particular one, and we have July 1st. Masters Wear Industry issued $700,000 of 12% bonds dated July 1st. Interest of $42,000 is payable semi-annually, okay, on June 30th and December 31st. The bonds mature 3 years later on June 30th, 2021. The market interest rate for the bond of similar risk is 14%, and we've purchased it now. So we're going to be doing the accounting for who? United Intergroup, the group that has purchased this bond investment, right? When we talk about the bond liability, we'll be doing the accounting, and I don't know if it's the same company names, guys, but if we were doing chapter for bond liability, we would be doing the accounting for the issuer, right? So the issuer is the borrower, the investor is the lender here, right? The investor is going to be buying these bonds, okay? Now, we go ahead and we talk about calculation of the price of the bond. And when we look at bonds, we look at them in terms of two cash flows. One is going to be the payback of the principal that's going to come at the end of the bond. That is a one-time payment that comes out when the bond matures 3 years from now, whatever it is, right? Then what? Then we look at the interest payments, and for this particular bond, it is a semi-annual bond, meaning it has two interest payments, one in June and one in December. That's 2 a year. That's semi-annual. Okay. Now, if you want to figure out what the price of this bond is, what someone should be willing to pay for this bond, you have to take those two cash flows and you have to get the present value of those two cash flows. Now, they don't show us the tables here, but for the principal amount, you would go ahead and pick up the present value of a dollar factor from the present value of the dollar table, or you might have a financial calculator, but it is what? It is a one-time payment, isn't it? It's a one-time payment. Okay, so we go ahead and we look to the table to get this factor. Notice very importantly here, guys, what do? We take it's a 3-year bond, isn't it? But since it's 2 payments a year, 3 times 2 is 6. So the number of payments we're going to go to the row is 6. And then when we go to the columns, we use what? We use the market rate of interest, right? And so since they tell us the market rate of interest here is what? Market rate of interest is 14%. We have to take that 14% and divide it by 2, right? Okay, and we do that for both the principal payments, but we have to go and we use those same two parameters, the 6 payments, the 14% divided by 2, the 7% interest, but we have to go to a different table. We go to the present value of the annuity table because it is a what? It is a stream of payments, isn't it? So we would go to the 6 payment row, the what? 7% column, and that factor will be there on the present value of the annuity table. Now, when you look at these tables, and I'll bring some in next time, I don't have them today, but They're in your book, actually, if you get the book, but I'll also put some tables up on the screen, maybe today, later, so you can see them. But when you look at them, sometimes, and this is more my introductory students get confused as to which table is which. All the numbers on the present value of the dollar table are less than 1, aren't they? Okay, and they have to be less than 1 because we know that the present value is going to be less than that future amount that we're going to have to pay 6 semi-annual periods from now. When you look at the present value of the annuity table, all the numbers are more than 1, and they're all more than 1 because it's what? More than one payment, isn't it? So if you ever get confused at what table you're on, you can guide yourself by that. Now, sometimes students will say, well, wait a minute, John. The one payment row, the numbers aren't more than 1. And I'm saying that if I was elected president, you know how President Trump signs executive orders? The first executive order you'd see me signing is that all present value tables, ordinary of the annuity, will take that one payment row off of that table because it's not an annuity if it's what? If it is more than, if it's only one payment, it's not an annuity. So they shouldn't even have the one payment row on the annuity table. And then my statement would be correct. All the numbers are greater than 1 on the present value of the annuity table. Okay? So you go ahead, you get the present value of the interest. Now, how did they get the interest? $42,000. And you look at that and you say, that is going to be what? The face of the bond, which is 700,000, and we're going to multiply that 700,000 by what? By 7%? Or should we use this right here? You use the what? Face of the bond, don't you? The stated rate, right? So you take the 700,000 times what? 12% divided by 2. Is that going to give me this 42,000? Is that where they got that 42,000? Okay, so make sure you're comfortable with that, guys. You're doing what? To calculate the present value, you're using what? You're using the market rate of interest. To calculate the cash payments, you use the stated or contract rate of interest, which if bonds were still printed, I'd be able to say, which is printed on the face of the bond. But these days, what? Bonds exist in book entry format somewhere in the cloud somewhere, who knows where they actually reside, at Charles Schwab or whoever, and so we don't actually see bonds anymore. But if we still saw physical bonds, and by the way, if you ever see a bond issued by a foreign company, you might actually see a physical bond. If you have a when you're doing an audit, you might have a client who has investments in foreign entities, and you'll actually see, I always used to tell my students at CPA, you'll never see a bond. Then they came to me and they said, well, yes, I did see a bond. Now, I've been auditing what? Gigantic government, U.S. government entities that everything's in book entry form, but you could have a client that's holding investments in a foreign entity, and then you may actually see a physical bond. But for the most part, they exist in book entry. But the what? The stated coupon rate that's on the face of the bond, we use that to calculate the cash. To calculate the what? Present value of those cash payments, those 42,000 annuity, we're going to do what? We're going to use the, everybody? Market rate of interest, right? I know that's distracting out there. No one wants to talk because there's a giant rattlesnake out there that's getting ready to come in, okay? So we would use what? We would use market for the present value, but stated amount, coupon rate, to figure out the amount of cash interest. Question? Okay, good. Now we come over, and that's how we calculate the bond price. And notice that even though the bond was having a face value of $700,000, someone is only willing to pay me $660,633 to issue this bond. Or since we're doing the purchaser's accounting, and forgive me guys, I'll slip into the issuers' shoes here from time to time, but for the what? For the purchaser, they're only willing to pay this 666,633. It's less than face, and it's less than face that the person is willing to pay because what? Because the market rate of interest is more than the stated rate, right? Nobody wants this bond. Nobody's willing to buy this bond for $700,000 because they're going to sit there and say, well, wait a minute, your stupid bond is only paying me 12% when the market's giving 14%. I'm not paying you full price for that bond, so what are they going to do? They're going to purchase it for less than face, aren't they? Now, I'm going to have to pay back I keep forgetting who I'm doing the accounting for here. The issuer is going to have to pay back what? Full face amount, the full 700,000, aren't they? Okay? And when they pay that extra, whatever it comes out to, 44,000 something, when they pay that extra 44,000 at the end, that is catching the investor up for all that time, for those 3 years that the bond was only paying the stupid little 12% when the market wanted what? Market wanted 14. Okay? So we're going to see that our interest is always going to be more than this 42,000, and that's recognizing the fact that at the end I'm going to have to cough up what? This extra $44,000, whatever it is. Okay? So we come over and we take a look, and just to help us remember, we have this slide here. If the interest rate is, what was our interest rate on that stupid bond? 12%. Okay, and let's just do it down here first. 12%. Okay, the interest rate on the bond won't change, right? It won't change. It's the stated rate. Okay, and then what? Then we have a market rate, and in our example, the market rate was what? 14%. So that bond sold at a discount. It sold at less than face, didn't it? Okay. Now, let's say, they didn't show us that, but let's say that our interest rate was 12%. The market rate is 10%. Now, everybody loves that bond, don't they? They're sitting there saying, oh, boy, you got a 12% bond when the market's only paying 10? I'll tell you what, I'll pay a premium. I will pay you what? More than face. That says more than face. More than face. Okay? Question on that? Okay, good. But we're going to be dealing with the investment here for this discount bond. And when we go ahead and buy the bond, notice we debit investment in bond $700,000. We credit the cash, obviously, for the cash that we got. We got that cash by taking the present value of the interest, present value of the principal, discounted at what? The market rate of interest. That's where we got that number from, right? And the difference is going to be called discount on bond investment, and we credit this $33,367. Now be careful, guys. Remember, we're doing the accounting for who? For the investor here. So this looks mirror image of maybe what you studied when you looked at bond liability, right? This is a bond investment now. It's an asset, okay? So if I go ahead and I prepare the balance sheet, right? And I'm going to be in the asset section. I'm going to show investment in bonds. I'm not going to write the whole thing out of how much? 700,000. And then I'm going to show the discount. And the discount here they're telling me is a credit of 33,367. So the net carrying value of this bond is going to be what? 666,633, which is exactly the amount of cash that I got. Okay. We call this discount what? What do you call that discount account? It is a contra asset, right? We call it a contra asset, meaning it is against the asset account, right? Okay, and we showing that, and we show that what? We show that investment net of the discount. Okay? Now, let me ask you a question. Let's say we're sitting down at a table with these people and we decide, you know, we're going to pay 666,633 for the bonds, and we have all our cash there, and we slide it across the table, and we eat a sandwich with them,
And then as we're about ready to walk out, they say, wait, we don't want to borrow the money. We don't want to do this. Forget legal. Well, did you sign already? Whatever. Pretend they could just tell us, wait, we don't want to borrow the money. What would we do at that point? Don't say call our attorney. What would you do? You loan your buddy 20 bucks and then your buddy says, oh, wait, there was 20 bucks in my, that little inside pocket that money gets slipped in. I found 20 bucks right here. Never mind. What would you do if you'd already given your buddy the 20? You would take back the money, right? You'd say, oh, okay, give me the 20 back, right? And they're being exchanged back, and everybody would consider themselves even, right? So right now, immediately after issuing this bond, we only owe them exactly what we borrowed them, 666,633, right? Notice, don't you love accounting? The balance sheet shows an investment of how much? 666,633, exactly what we just loaned them, right? Okay. Now, how much are we going to pay them back at the end? How much will we pay them back at the end? Huh? We're going to pay them the interest every 6 months, and then at the end of the 6 semi-annual periods, 3 years, we give them $700,000 back, don't we? Okay, so what? As we go along, this investment's going to get closer and closer to $700,000, isn't it? As we move through these time periods here. Okay? Okay, so keep that in mind. Keep your eye on that investment amount as it goes up. Now, do you pay interest to people on money that you don't owe them? Do you pay interest to people on money that you don't owe them? The answer is no, not in America that I'm aware of. I think it's probably illegal, okay, for them to try to do that to you, okay? So what happens? If, you get involved in some shady transaction like that, leave town quietly, okay? But assuming it's all on the up and up, we do not pay interest on money we don't owe people yet, right? Okay? And so what happens? When we calculate this interest for the first 6 months, we're going to calculate on the amount we owe them, which is the money we borrowed from them at this point, right? Excuse me. Again, we're doing the accounting for the investor. So they're going to pay us interest on the money we loaned them, right? Okay, that we invested in with them. Okay, so you come over and, let's just take a look at this question. Chan Inc. purchased bonds for $800,000 that have a maturity value of $900,000. Chan's journal entry to record the purchase would include what? Let's just do the whole transaction. How much did they purchase it for? Purchase bonds for $800,000? Guys, I'm not going to sit up here and talk to myself. If you're telling me you got all this already and I'm wasting my time, we can just go home early and you can just look at the slides on your own, right? So we got a credit to cash for what? $800,000. Good, that we purchased the bonds for. We've got what? We've got the investment for $900,000. And so we need a credit to make this journal entry balance. I know that much. And that credit is to what? The discount. Good. So the answer here is what? B? Okay. Okay. Oh, okay. Wow. All right. So the answer here is B. All right. Good. Okay. Now you come over and, okay, they showed me the journal entry anyway, so I can erase this, which is what we just wrote up there. Okay. Okay, good. Now we come over and we calculate the cash interest. We're going to pay $42,000 every 6 months on this bond. We take what? The face times the stated coupon contract rate. Those terms are all synonymous, right? Okay. And that gives me the $42,000. Then what? Then to figure out the interest revenue, I take that. How much money did I borrow from the guy? 666,633. You pay interest or you receive interest on what you loan, on what you borrow, right? And right now, that's all we borrowed from this person, right? Or this is all we've invested with this company. And so we take this now market rate of interest to calculate the actual interest expense, right? Cash interest, it's the stated rate.
the actual interest revenue slash interest expense is going to be what? Going to be the market rate, which was 14% semi-annually divided by 2. So my interest revenue is 46644 here. Okay, so I go ahead and I make that journal entry, which is to debit the cash for the cash interest I'm receiving. I go ahead and I credit my interest revenue for the calculation that we made by taking the carrying amount of the bond and multiplying it times the market rate of interest. And then, of course, I debit the cash because they're paying me $42,000 cash. Now, if we take a look at this, I'm going to put this up on the board. We're going to have the balance sheet. And before I do the balance sheet, let's just go ahead and let's tee up the discount. And so when I went ahead and I first purchased the bond, I had credited the discount for what? $33,367. Okay, so it had a balance of $33,367. That was my original credit to the bond when I purchased it, right? Okay. Now when you look at this journal entry, they're telling me that I would debit the discount, and I'm going to debit the discount for 664. And so right now the balance in the discount account is 28,703. Am I good on my math? 28,703. Okay, that's the amount in the discount. Now if I go ahead and I prepare my balance sheet right now, I'm going to show the investment. How much is the investment, guys? Don't use your imagination. Nothing's happening in the investment account. I'm still carrying the 700,000, right? In accounting, you don't use your imagination unless what? Unless I tell you to. Otherwise, don't use your imagination, okay? The discount now, don't use your imagination. How much is the discount? 28,703. Discount is a contra, so it's subtracted off. So the net carrying value of this investment is how much? Calculators. Calculators. 671,297. Hello? What? Calculators, guys. This class, you bring calculators and you participate. Okay? If you sit here and you just watch me do it, you think, oh, I'm really understanding this. I'm really going to be good at this. I went and watched people work out last night. Look what it did for me. Okay? You have to what? You have to actually do it, don't you? To get the benefit from it. So work along with me here. But notice what? It's now 671,297. Has the carrying value of this investment gone up? Has the carrying value of the investment gone up? It was this what? 666 whatever 633, wasn't it? It's gone up from that to what? 671 something? It's gone up, and it should go up because what? Because I'm going to get 700,000 when this thing matures, right? Question, guys? In the back? No? Seemed like you had a question? No? Okay. Hello? We're good? Okay. Okay, good. Now, at this point, I would go ahead and I would go into the next 6-month period with this as the carrying value. And when I calculate my interest revenue the next 6 months, I'm going to do what? I'm going to multiply this times the new carrying value, right? Okay, and this is how we'll go along with this. Okay, so we come over and you can see that we have now this full-blown table here in which we're going to calculate our cash interest. That's our first period. We just calculated that. Here comes our second 6-month period. There's my number 671,297, right? That gives me the cash revenue. And notice, I mean, not the cash revenue, but the actual interest revenue. Cash is going to be what every single time? 42,000. The cash interest is always based on the what? The face of the bond times the stated rate, coupon rate, contract rate. Those are all synonymous terms. That won't change. So that 42,000 is like your best friend, isn't it? It never changes. What do you say to your best friend? Promise me you'll never change. Okay, 42,000 promises it'll never change. It'll always be 42,000 for this bond, right? Okay. Okay, good. Now we come over and notice we take the what? Market rate of interest, the what? 0.07. The stated rate was 0.06. The market rate is 0.07 times the new carrying value. That gives me my new interest revenue for that next 6-month period, doesn't it? The difference between that and what? And the cash interest is going to be the amortization of the discount. And since my discount was decreasing the carrying value of the bond, as I amortize that discount down, then the carrying value should go up every 6 months by the amount of the discount amortization, shouldn't it? Right? The discount was a subtract from the bond. If I make the discount less, the carrying value is going to go up by the amount of the discount amortization, right? Okay. Now, you look at that and you say, okay, if you say so, John, but intuitively, you know it's got to go up. I mean, that much you know for sure, because how much are we going to receive at the end of this? The full 700,000, right? Okay, we would just continue on like that. Okay, now these amounts right here, guys, that the bond has as a carrying value every 6 months is called the carrying value of the bond is going to be used here, and we're going to call that amortized cost. We call that amortized cost for this investment because it's what it cost us, which was the original amount, the 666,633, but as we're amortizing that discount down, it's going to change period to period. So we call this amount right here the amortized cost of this bond. Okay, remember that term, amortized cost. Questions so far? Okay, good. Now, that's the easy part, which is to sit there and calculate the interest revenue every 6 months, taking the new carrying amount and multiplying it by the what? Market rate of interest, right? That's our interest revenue. That accounting is pretty straightforward. But we're going to have to also look at changes in market value of this bond over the time the bond is outstanding. Now, why would the market value of a bond change? The market interest changes, right? What happens? What's your name again, sir? Say it one more time. Arthur. Sorry, Arthur. So, Arthur, right, when we issued the bond, we issued it when the market rate was what? They said 14%, right? What happens if the market rate of interest starts to climb 15%, 16%, 17%? Do people like my bond anymore? I'm happy. The issuer's happy, but the investor's thinking, oh, this is a lousy bond. Nobody wants to buy it. Price is going to go down, right? If interest rates start to drop, everybody's loving that bond, right? And the investor's going to say, I'm hanging on to this, right? Meanwhile, what? The issuer's thinking, I hope I have a call option on this bond so I can get this stupid thing off the market, right? Okay, but we'll talk about that in a later chapter. Good. But as the market rate fluctuates, the what? The price of the bond will fluctuate, okay? Now, if I'm going to hold this bond to maturity, do I care? Doesn't matter. Doesn't make any difference to me. If I'm going to hold the bond to maturity, the interest rates can do whatever they want. I don't care because I ain't selling this bond, right? Think about it if you bought a house and the price was this amount and the interest rate is 3% or something, right? And let's say all of a sudden the interest rate drops even lower. Interest rate 5%, interest rate drops to 3%, but you've decided you're going to die in this house. Well, you don't care what happens to the market rates or the interest rates at that point, right? Same principle, okay? So, if we have a bond that we plan to hold to maturity, we just turn off our accounting lens off of the price of that bond, and we do not recognize unrealized holding gains and losses due to market fluctuations in the price of that bond. We do nothing as a result of that. So we just carry on every 6 months the way we just saw on those last couple slides that we were looking at, right? Okay. Now, what happens, though, if we are in a situation where we are actively trading bonds? Okay, so we're probably what? A bank or a broker or somebody like that that's watching those interest rates maybe by the hour and dumping things and buying other things as we go along, right? Well, then that's our day-to-day normal course of business, isn't it? And so the accounting standards tell us that we have to mark that investment to market on the balance sheet. And when we look at the examples, I think they'll do it annually, or maybe they'll do it every 6 months or something, but you could do it daily. But we're going to mark those bonds to market on the balance sheet, that bond investment to market on the balance sheet, and any unrealized holding gains and losses will go straight to the income statement. We call those trading securities. We report that, and if we were a bank, it'd be part of our operating income. If we weren't a bank, let's say we were a manufacturer, that's not our normal course of business, so it would be down in our non-operating income. But it is going to hit the income statement and affect my net income if it's called a what? Called a trading security, meaning that I am actively trading this on a day-to-day basis. Okay? Now, the way the standards look at this, the way FASB looks at this, they say, okay, you either have a trading security or you have a held-to-maturity security. If you can't fit something into those two categories, then we're going to have a middle category for you, sort of like the purgatory for investments. We're going to call it available for sale. We'll call it available for sale. And the balance sheet treatment is going to be exactly what we said for the trading, which is on the balance sheet, we will mark that security to market. Again, it could be hourly, daily, every 6 months. I think in the examples we'll look at, it'll be every 6 months. But we're going to mark it to market on the balance sheet, just like you do the trading security. Now, though, any unrealized holding gains and losses will be considered part of my other comprehensive income. And you remember that you take what? Your net income plus your other comprehensive income equals comprehensive income, doesn't it? That was the day you realized you were truly an accountant, when you walked in the door and you said, guess what? Today we learned about comprehensive income. Really? What'd you learn about? We learned that other comprehensive income plus net income equals comprehensive income. And everybody said, your parents said, what did they do to my baby? Right? Okay, so we're going to sit here, we're going to see that if that's the case, then for available for sale, any unrealized holding gains and losses will go straight to what? Will not go straight to the income statement, will go to other comprehensive income. Okay? Okay, good. So we come over and we take a look at the examples here now. Okay, and you would have to disclose information about this. I'm not particularly interested in this footnote disclosure for Bank of America, whoever. Okay, you would have to disclose what methods you're using as part of your summary of significant accounting principles. Okay, and let's just go over and let's just look at the example. I think it's a little easier for us to understand what's going on. So we have this Wall Street Journal indicates that the fair value of the bonds that we just invested in is $714,943. How would we account for this? Now this is at 12/31/18, so I think it's just after we've done this where it was having a net carrying value of 671,297. Okay, or is it? Maybe it's 6 months after that. Whatever. The market value is what? More than the carrying value. I know that. How do I know that? How do I know that?
Right. The biggest the carrying value could ever get is 700, and it's more than that, right? And I'm not sure where we are, if we're at this point or 6 months down. I forget which date this was. I probably should have put the date on this, okay? But let's just go ahead and let's take a look. And if it's a what, HTM, held to maturity investment, the change in fair value is ignored. We do nothing. We do exactly what we did when we were looking at it a minute ago, right? Okay. If that's the case, we will need to disclose the fair value, however, right? And disclosures about fair value are commonplace now. Okay, there was a time where that was a big deal. Should we disclose the fair value or not? Now that's obviously commonplace to do that, and we're literally going to do some accounting around fair value if it is what? If it is a a trading or a available for sale security. Okay. Now you come over and let's say that they decide to sell this investment. Okay, now they say due to unforeseen circumstances. Why? Why did they have to say that, due to unforeseen circumstances? Are they just trying to be dramatic in their writing? Why do they say due to unforeseen circumstances?
They're trying to say that their primary goal wasn't to trade the bond, but
Yes.
eventually they had to.
Exactly. Okay, because you call it held to maturity, you have to have the positive intent and ability to hold that to maturity, don't you? Okay. If you were auditing a company and they told you that they were carrying a securities held to maturity, how would you audit their intent? How would you audit their intent? Would you say, stay still? I'm going to go deep into your mind to see what your intents are. How would you get to their intent? Not that this is the auditing class. How would you get to their intent? You'd put it in writing. There's something called a management representation letter that you get in an audit, in which you would make them write down, for those securities that are held to maturity securities, we have the positive intent and ability to hold them to maturity. You literally make them put that down in writing, right? Okay. So, due to unforeseen circumstances here, though, they decided to sell the investment for $725. Okay. And so what happens? They would go ahead and they would debit the cash for $725. Okay. And I guess it was after the January transaction that the bond's discount was $28,703. So it was after that first interest payment, right? After the first interest payment, so they would debit the discount to get rid of the discount, to take that off the books. They would go ahead and credit the investment to get rid of that, and the difference between the carrying value of the bond and the price they sold it for is going to be the gain, isn't it? Okay, so you could also get to the gain by doing what? By sitting there and saying that the carrying value of the investment was this 671,297. How would I set that up? I'll write it on the screen. How would I set that up? Who wants to set that up? How much did I sell it for? 725,000 is the cash proceeds, right? And the carrying value was how much? 671,297. Is that the gain? 53,703. Right? Guys, accounting is not a spectator sport. It's one of these kind of sports. Okay, so calculate along with me as I'm setting these up. I'm telling you, it'll pay dividends to you. The more you do this, and you're going to be doing this for a long, long time, you might as well get used to it. Okay, the more you do this, the better you get. Just watching
is not the best way to do this, okay? But you could also get the gain that way, right? I'm just telling you, I could ask you a question, give you the same fact pattern, right? And you want to know how to calculate the gain. Are you going to have to do a whole journal entry to get the gain? Or could you do it by just saying what? Whatever you sold it for versus its carrying value is going to be the gain on this, right? Okay, okay, good. Question? Okay, now we come over, and that's the held to maturity. Okay, and when we look at the income statement, any realized gains means that I sold the security. If we call it a realized gain, that means that I sold it. If we call it an unrealized gain, that means that there's been a change. I've recognized a change in the market value of the bond, but I haven't sold it yet, right? And we'll call that unrealized, okay? But this is a realized gain, and those gains and losses are shown on the income statement. Unrealized holding gains and losses would be what? For a held to maturity security, we simply disclose it, right? Because we haven't sold it yet. Okay, there's no journal entries associated with the situation if we haven't sold the security yet. Okay, and there's no effect on comprehensive income. Other comprehensive income gets affected by our available for sale. This is held to maturity. The investments are reported at what? Amortized cost. Before we sell the investment, it'd be showing up like this, wouldn't it? Amortized cost. Okay, in this case, since it was a discount bond, the investment minus the discount. Okay, and what? Fair value is going to be shown where? In the notes. On the cash flow statement, cash flows from buying and selling trading securities are classified as investing. Okay, the cash flows from the buying and the selling go where? Investing. Okay. How about the interest revenue? Statement of cash flows, interest revenue. Who said that? Good. That goes where? Operating, right? Why? Why does the interest revenue go into operating? Meanwhile, the cash from selling it and the cash for buying it goes into investing. Yeah. It's included in the net income. Isn't that annoying? It's very annoying. Bugs me. I sit up at night sometimes. I literally sit there staring at my ceiling going, why does FASB put interest revenue in the operating section? It doesn't belong there. Please make them change that. Every night I say that, okay? It's annoying. But what? It's the obsession with net income that causes that, right? Because we reconcile net income to cash provided by operations. And since net income is constituted of both our what? Operating and non-operating items, we get into this dysfunctional thing where interest revenue, which would be non-operating, gets what? Reported, the cash interest gets reported where? In the operating section on the statement of cash flows. I tell you, it's dysfunctional. It's ridiculous. That's why you have trouble remembering it. So that's why I asked who said that, because it doesn't intuitively it doesn't rhyme, right? It really should be what? Down in investing, shouldn't it? Since we made an investment and we got interest revenue from it, but because we start with net income, we have to reconcile to cash provided by operations. Interest revenue and interest expense, quite frankly, are where? Up in the operating section. Good. What happens if I trade these bonds on a day-to-day basis? Let's say they're going to be trading securities. Well, I'll hold that. I'll hold that suspense. That'll keep you intrigued. He's going to tell us what to do with not the interest, but the proceeds from the sale and purchase if they're trading securities. So hang on to that. Or did you want to answer? Somebody looked like they wanted to answer. That's okay. You don't have to answer. I thought maybe you wanted to. Okay. So we're going to put what? The interest revenue in operating, but the proceeds from the sale and the purchase of the investment go where? Into the investing section on the statement of cash flows. Good. All right. So we come over and we take a look, and they do a nice job here of showing us. And guys, notice we have a statement of comprehensive income which is our what? Net income plus our other comprehensive income equals comprehensive income. When you get on the bus, when you're going home this afternoon, you get on the bus and somebody sits next to you, you don't want them to sit next to you, just look at them and say, did you know that net income plus other comprehensive income equals comprehensive income? They'll move. Okay? All right, so what happens? We have that. Okay, and then what? Notice there were no other comprehensive income items for this held to maturity security, right? There's our interest, and they give us our what? Our interest revenue for year one or whatever it was. Yeah, 2018, the first 6 months anyway of that investment. And then what? Since we sold it right after that, then what? There was no more interest, but we did have this what? This gain from the sale. Okay. Notice, guys, that these are not revenues minus expenses. They are not part of my operating income. They are non-operating items, but they are part of my net income on the income statement, right? Okay. On the balance sheet, what? In 2018, after that first interest payment, there's the carrying value of the bond. That's 671,297. Of course, I sold it. Now it is what? Now it is 0. My retained earnings, and they're just assuming we just had this one transaction, right, would have been increased by the amount of interest in year one, and then, of course, you take the 44644. That balance, the retained earnings rolls forward, plus the gain from the sale gives me my ending balance in my retained earnings, right? Statement of cash flows, there's the annoying, and notice, guys, it's what? Cash interest, not my interest expense. It is what? The cash interest that shows there, right? Now, this is a little annoying too, because what it would really show is my net loss, my net income. If this was the only transaction, what would my net income be? This is how it would really look on the statement of cash flows. If this was my only transaction for year one, what would my net income be? Guys, it's right there. My net income is that, right? If that was my only transaction, that's my net income. So I would start with net income, wouldn't I? If I was doing the statement of cash flows and I'm in the operating section. I'll start with net income. How much is my net income? 46,664. And if this was the only transaction, I now have this $42,000 cash, don't I? Okay. So what would I do? I would go ahead and subtract the discount amortization. And the discount amortization we know was this, where was that number? 4664 was the discount amortization. So I would subtract the discount amortization 4664. I probably didn't have to look there to see what it was. So my cash provided by ops is actually the what? The 42,000? Yeah, we're talking indirect method here. Yes, that's correct. Yeah. I'm just showing you the indirect method. If it was the direct method, I think we do have to call out the interest, cash interest that was paid. We call it out in the direct method. Okay, but indirect method, most companies use indirect method, don't they? Okay, so we're a little bit indirect method centric, at the universities and stuff. Which method would FASB prefer entities use? Which method for the statement of cash flows has FASB called out as the preferred method? They've called out the direct method as the preferred because it's more informative. Cash paid to suppliers, cash received from customers, cash interest received, cash interest paid. It's much more informative, isn't it? but it's a little too informative in that now our competitors can say, I see that John Company is paying a little bit more cash to his suppliers. What's going on here? And start to dig into that and maybe get behind some of the operational aspects of my business that I prefer they not. And so FASB offered this other method, which reconciles net income to cash provided by operations, and it turns out that everybody just uses that method. In part, also that it conceals some things, but also it flows straight from the financial statements. You got an income statement, you've got a balance sheet, you can prepare a statement of cash flows from that income statement and balance sheet. So that's another reason that a lot of companies might choose the indirect method. Okay, so I'm just saying that to you so that when they say, cash from interest, you understand that it's not just, a number that's necessarily plopped there. You would derive it like that. Okay? Okay, good. Question? Okay. Okay, good. And then down in the investing, we have the cash flow going out for the initial investment, and then we have the cash flow coming in for that sale down in the investing section. Questions? What time does this class get out? 1 o'clock? Okay, good. Let's go ahead and let's take a look. And we say July 1st, 2018, Williams issued $600,000 of 10% bonds dated July 1st. Interest is payable semi-annually on June 30th and December 31st. The bonds mature in 10 years. The market rate for the bonds of similar risk is 12%. Is this bond going to issue at a premium or a discount? The what? The stated rate is 10%. The market rate is what? 12. This bond's going to issue at a discount less than face, right? The entire bond was issued by Joe. Due to unforeseen circumstances, they decided to sell the debt instrument for $550,000 on January 1st when the bonds had an amortized cost of $580. Now, if we wanted to make this a real interesting question, we could have sit there and gave you a present value table, made you do what? Calculate the purchase price of the bond, made you amortize a little of this discount, and then sold it and told you, what they sold it for, and you would have had to calculate the carrying value yourself, right? Wouldn't that have been more interesting? Okay. Okay, that would be probably a full-blown problem. Oh, on your test, we'll take the whole class period for that date that the test is going to be given, and it'll be 25 how long do we have? 2.5 hours. So maybe 20 multiple choice questions in one free response, unless you want 25 multiple choice questions. Think about it. I'm flexible. I could go 30. I will never go more than 30. I've had students say, we want 50 multiple choice questions. Why do they want 50? More margin for error, right? But then they come at the end of the test and go, why did you give us 50 questions? Because you wanted 50. Okay, so now I cut it off at 30. I'm thinking the right size is 20. If you want 25, I'll give you 25. That way, your base is less. And what I'll probably do, if we do 25, it'll be 3 points per multiple choice question. That's 75, and then 25 for the free response. Or if we go 20, then it'll go to an 80-20 split, because I don't want to be dealing with weird numbers. Like, 4.2 points per multiple choice I don't want to deal with. So it'll go up to 4 points. Okay? Okay, so that might be a full-blown question. But anyway, so they went ahead and they decided to sell the investment for $550, and the bonds have an amortized cost of $580. What would the sale include? Well, if you think a credit to cash is correct, because we're getting cash, right? So there's no way it's a credit to cash. How about a credit to the discount of 20? I don't know. I can't tell you for sure. How about credit to investment of bonds, $600,000? and debit to gain. Is it a debit to the gain? Huh? No. No, we're doing okay. We've got it's amortized cost is 580. Oh, I see. Amortized cost is 580 and we're selling it for 550. So you're right, we're going to have a loss here, right? Okay. But it's not a debit to gain. It would be a debit to loss, right? Okay. Sorry, guys. That never happens. Do we credit the investment for 600,000? Huh? Well, we got to get rid of this investment, don't we? We're going to take the investment off the books. Okay, so let's just go ahead. Let's take a look at that since we're not visualizing the journal entry. I think they probably give it to us here. So what's going to happen? We're going to debit the cash. We're going to debit the discount for 20,000. I guess I should have been able to figure out the discount, but if it had advertised cost of 580, but it's not going to debit the discount. It's going to do what? Credit the discount to get rid of it, right? And then what? Loss on sale. It's loss. It's not a gain, but we do have to credit the investment in bonds for 600,000, right? Okay. We debit the discount to get rid of it, not credit it. Okay. Okay, good. Let's go ahead then and let's stop right there. Okay, I'm going to stop there because I don't want to get into halfway into the stream here of trading and available for sale, and then we can't finish it. And meanwhile, it's helpful in the explanation if we can compare them. Okay, so next time we will pick up chapter 12. We'll finish that. I will put quizzes up for chapter 12, 13, and 14 so that you can start to see some of the quiz questions. So next time we'll finish chapter 12. We'll do the quiz for chapter 12, time permitting. We'll start to run into chapter 13, and we will be constantly behind on the syllabus throughout this whole class. And that's about how it goes. Okay? Question, guys? All right. I will post up whatever information I get about the textbook and the options, but I'm thinking right now it's the 140 whatever. No ebook. If you want the ebook, it's $80, but I'm going to call and follow up on that to find out, well, is there a set price for the full hard copy book if students want that? And again, if you don't want any of that, don't get any of it. It's going to be like this. I'm going to do the slides. I'm going to mark up the slides. I'm going to put the slides on the website, B courses. I'm going to record the lecture so you can see that. I'm going to put the quiz, okay? But if you want more batting practice, then there's homework questions there that'll give you more batting practice beyond that. The other thing I'll do, I just probably shouldn't record this, whatever. The other thing I'll do is I'm going to put up the solutions to all of the homework, okay? That's 9th edition. I'll put up the solution to all of the homeworks on there. So you could go get, a copy of the book, from Amazon, like the 8th edition or something for $20, and then knock yourself out on any of the homework questions you want for extra batting practice. So it'll be all right there, and you could do that too. Okay, if you're feeling like, well, geez, John, a few quiz questions, your examples, and your discussion in class, and that's all I got to practice with. Well, no, I'll also give you a practice midterm to practice with, but that's still sometimes people don't feel that's enough weightlifting. And so if you want to go ahead and get some more and you still don't want to buy the Connect, what I'll do is I'll put the solution manual up on B courses. You get a copy of the book from Amazon for $20 or something like that, and then you can work all the homework questions you want. And then we can go over them in the discussion, I guess, in office hour and stuff. All right, guys, have a good rest of the afternoon. I will see you tomorrow. Thank you. Yeah. Thank you for participating. Appreciate it. Helps to make the class go.
I just wanted to let you know that I will not be here on Friday and Monday.
Okay.
I
Okay.
haven't been there.
It's optional. Yeah. Okay. All right. Okay, thank you for letting me know. Okay, see you. Hmm. I'll just put them in.